Hi all, welcome to another video of Indian Financial Service. The topic discussing in this video is infrastructure finance. So infrastructure finance is a financial assistance that is given for the development of infrastructural facilities. It is an investment made for the development of infrastructural facilities such as rail, road, airport, shipping port, hospitals, etc. It is normally it is a social overhead capital that is spent for the development of the society. That is the importance of infrastructural financial assistance. So let us see what is the concept of infrastructure. It is a general term for the basic physical system of a business. In the things that is especially from the point of view of a business, it is a basic physical things that is will be helpful to support the proper running of a business concern. Especially in the cases of the system of transportation, communication system and communication network, then water supply, electronic facilities, etc., etc. So many things are there. These are all called the infrastructural facilities. These systems, normally once you are providing these systems to an organization, the objective of providing such assistance or facilities, it requires a high amount of investment or a huge capital investment for developing of such facilities or systems. So in case of country's point of view, a national point of view, a country's functioning or a country's development of a nation, infrastructural facilities are the essential part or the essential variable for the development of a nation. So that is why the importance of infrastructural financing is essential or vital for the development of our economic systems. Let us see the types and components of infrastructural assistance. So in cases of environmental sectors, the investment patterns are like examples are investment in water supply and treatment, drinking water supply and treatment projects. Then in case of a waste management system, so how to manage effectively managing a waste management system, then how to manage a solid waste management system. So infrastructural facilities for development of a solid waste management system. Then in the part of pollution, so what are the effective measures that you can take for that is reducing the pollution problems in the point of view of an industry? Like we are going to make plantation, that is plantation like trees and all the entire that is premises of your factory or your business concern. So that will be helpful for reducing the problem of pollution, especially some of the industries like cement and all. The outcome of pollution will be very high, so as compared to some other industry. In such case, so these are some of the techniques that you can helpful for reducing the pollution content of that particular situation. Then in second part, as we are discussing about the telecommunication sector, like every second there will be upgradation of telephone technologies and all. So telephone lines and networks, we are discussing about the technology that we are discussing. So the basic infrastructure facilities, now it is upgraded to 3G, then 4G, then now it's coming the 5G. So the changes of that one is also the development of an infrastructural facility. So now from GPRS to that is 2G to 3G, 3G to 4G, now we are moving to the 5G. So the high speed internet So once you are using the high speed, those who are using the 3G, the speed of internet will be very high in 4G. So if you are going in the 2021, there will be some announcement is that 5G is coming. When 5G is there in this situation, the speed of internet will be again is going too high. So that is in case of telecommunication sector. And in case of public health, so healthcare and facilities and hospitals, healthcare facilities and hospitals. So what is the importance types of healthcare things that you can do? So what are especially what we are seeing right now is the corona pandemic situation. So what are the things that you can do, infrastructural facilities that you can do during the time of corona pandemic situation? So type of facilities that you are going to provide during the corona pandemic situation. So how frequently we can measure the things, that is those who are admitted in the hospital. So how frequently the kit and all that you can provide to those patients, those who are admitted due to coronavirus situation. So how effectively the hospitals are functioning. So that in that part, healthcare part or health management system, the development of infrastructural facilities are most important things. Like the most I'll give you another example like this. If you are going to hospital, normally we are looking towards the hygienity, the cleanness and other things in the hospital. So the infrastructural facilities for making the hospitals in an effective manner, like it will be a cleaned one, things that you can see in the hospital is perfectly that is it is accessible for the patients. So facilities that they are providing, the assistance that they are getting from the hospital, so that is the important thing. So in order to enhance that one from the front office to all other areas, the infrastructural facilities are the most important components for the development of an hospital, especially in case of a public health situation. So I have taken three important sectors. So sectors like environmental factors, telecommunication sector, and public health sector. So all these are the three important sectors. It's a lot of sectors are there. So transportation is there, education is there. So I have taken three sectors. So these three sectors we are going through different areas where the infrastructural development we can do for enhancing the development of the system. Then let us see the infrastructural finance part. So infrastructural finance is a business line work on expanding the infrastructural finance market across the economies. So especially you are expanding the infrastructural finance market across the economy, and in that case leveraging the private funding from institutional investors and reducing the rising infrastructure finance gap in emerging market economies. This is one of the meaning of infrastructural finance. So you have expanding the infrastructural financial market and providing the financial assistance, supporting and funding to the institutional investors. So and that will be reducing the infrastructural financial gaps, especially there will be a shortage in a particular area or a particular sector, there will be a gap. So identify that particular gap and providing the financial assistance and support, especially in infrastructural development. So that will lead to emerging market economies, EMEs. So this is the one thing. And financing is how you pay upfront your infrastructure. So if you are getting finance, so you are paying the that is some amount of, so you are getting some amount of fund for infrastructure. So how you pay in to upfront your infrastructure. So you are developing your infrastructure. So in this case, the government and private sector companies have their own space, have their own ways. They can do several things for infrastructural development. Especially what we have discussed about the development of things like road and railways and all that things. It is a part of government. for developing the infrastructural facilities of some things like rail, road, airport, and all that things. So in private sector also, in private sector companies also, they can do some sort of infrastructural development things like upgrading the existing technologies to a new one. So that is the things a private sector company can do for their infrastructural development. So the financing from the part of both these things, in part of government and also the part of private sector companies, for enhancing the infrastructural functions and operations. Let us see the definition of infrastructural financing. There is no clear-cut definitions. There is no formal definitions, especially from the part of financing infrastructural facilities. But there are some definitions like this. Most of the countries around the world, the government issues a list of industries that are to be given infrastructure status. So in most of the countries, as you know, the government issues a list of industries that are to be given infrastructure status. So if you are giving some financial assistance or financing financial assistance of these companies involved in that particular sectors, so that is called the infrastructure financing. So that is the one of the definition that we can give for infrastructural financing. And in that case, if you feel that the government has identified some of the industries or some of the financial institutions that is the most viable thing, and where there is some requirements of funds for the development, like what we are seeing that in cases of small scale industries, SSI units. So maybe we have discussed the same thing in entrepreneurship development, small scale industrial development. So financial assistance in different forms like seed capital, or those who are running the financial assistance for their working capital requirements. Several things are there. So here there is some sort of assistance for enhancing their infrastructural facilities and systems. The types of infrastructural financing, the different types of infrastructural financing are there, and three important types of infrastructural financing situation. And the first one is the economic type of infrastructural financing situation. So the financing is purely for economic reasons, and here there will be public-private partnership is there in this type of projects, and having a public-private partnership is there. So this is a type of infrastructure financing where there will be some purely economic reasons for or assistance for such type of financial requirements. And this is because the projects have net positive value. This particular project have a net positive value. There will be we are expecting some sort of positive outcomes from the part of this project. We are expecting that we are getting some sort of positive outcomes. We are getting some sort of positive results from the part of this project. So that is why the project is called it is economically viable projects. There are some projects that is economically viable projects, and financial assistance is given from the part of for the economic development of the nation. And in this case, the value created can be shared. The infrastructural funding value or the assistance can be shared in between that government and the private parties. So there will be a sharing between the two parties, that is the government and the private parties. They are sharing this infrastructural financial facilities. And here the economic infrastructure projects provide benefits to a larger economy. Once you are doing all these things, we are expecting that you have a project, and the project will be benefit to a larger economy of the region instead of providing benefit to a specific industries or people. So we are giving some sort of facilities to in the economic point of view, we are thinking that it will be benefited by a large group of people. It is not concentrating to a single area or a single group of people. We are expecting that it will be benefited to a large volume or a large group of people or a large number of people. So this will be supporting a large number of people. This will be enhancing that will be enhancing the development of industry, which will be benefit to a group of people residing in a society or a nation or somewhere else all over the world. So only that type case there will be the facility of economic infrastructural financing situations. Let us see the second one, that is a social part. Infrastructure funding is given for some social cases also. So they are providing assistance. They are giving that is assistance to something which will be benefited to the society. Like we have discussed, the facility that is given in the healthcare sector, facilities that you are given in the educational sector, infrastructural facilities given for supporting the environmental pollution and all. So that will be the benefit of the society. So ultimately it will be focusing for the benefit of the society. So that is why this is the second type of financial assistance, socially viable financial assistance situations for infrastructural financing. In these projects, it is different because they have been undertaken regardless of the fact that they might have a negative net present value. Normally, if you are spending something like for the development of a society, if you are providing investing some amount in healthcare sector, especially government's point of view, you are spending some amount in healthcare sector or education sector, there is no return. So you are expecting that there will be a positive. Once you are giving the education to the society, there will be a upliftment. There will be an upliftment of the society. There will be an upliftment of the people, those who are residing in the society. And in that case, the return, there will be a negative return from the part of this investment. But you are expecting that there will be a positive impact. There will be a positive growth. There will be a positive results in the future period of time if we are making such type of investments. So this is the second one, and the third one is the commercial aspects. Three aspects are there, and the third one is the commercial aspects. It is just like the economic projects. So you are identifying that there will be some sort of benefit that is getting from a set of people who that can be directly identified. So there will be some sort of benefit that is getting from those who are actively engaged with that particular projects. So these are the three types. Let us move to the methods of infrastructure finance. So what are the different types of methods of infrastructure finance? Financing is distinct from the from funding infrastructure. So you are funding something that is different from financing. So here there are two ways we can classify two methods are there for infrastructural financing, and you can give publicly and privately. Public financial assistance are there and private financial assistance also there. And public part, there will be the part of infrastructural facilities like road network, communication, etc. That is a part of the government, and all these things that will be there in the public part. And as we are already discussed that one. And in cases of privately financial, that is privately owned business concerns and their infrastructural facilities, that will be discussed in the second part, that is called a private infrastructural part of infrastructural finance. So in cases of infrastructural finance company, it is a financial institution engaged in principal business of a infrastructural loan. So a finance concern is called an infrastructural financing company. A lot of infrastructural financing companies are there. So that company is called an infrastructure financial company. That company is engaged in principal business of infrastructural financial assistance in the form of infrastructural loans. They are giving the financial assistance in the form of infrastructural loans. And here the first part is the public infrastructural financial assistance. So it is a public financial assistance for infrastructural come from variety of sources, principally taxation but also public borrowings. So this is the infrastructural facilities that will be basically focused for the public development projects. So where there will be public spending will be more, in that type of projects where the public spending will be more, and public finance for infrastructural project will be on the public sector balance sheet in measures of public sector net debt. So that amount that you are spending, the finance for the public sector institutions that you are providing infrastructural finance, that will be appeared in public sector balance sheet in measures of public sector net debt. And some of the advantages of this one is the cost factor. The low cost will be there. It is more borrowing that fund is compared to other financial assistance. That is, government can borrow more cheaply than private sector. That is the first important thing. And the risk factor is comparatively low. So you will get a low risk factor and the low cost situations. And the second one is the flexibility. So you can have, it is more flexible rather than you can make the changes according to the situations. So in cases of a future, there will be some sort of a maintenance cost of running that particular thing and all. In all that part, you can make very flexible of such type of financial assistance. And coming to the limitations, so the competition for spending may leads to underinvestment. So a lot of financial institutions, they are ready to support infrastructure, but there will be the competition from the part. So that will be leads to underinvestment of such type of projects. And another important problem what we are seeing is the length. So there will be a length of finance and its repayment. So long time investment will be there, and normally the financial infrastructure through the public finance can take a long time. It will take a long period of time, and the repayment period is very long. So that is also will create a negative impact in the point of view of a concern. Then cost and time overrun. So cost factor and time factor, two important factors that will take that is any type of financial assistance or a support. So when a project is publicly financed, so there will be the part of government, they are managing that process directly. So in that case, we have a problem of the cost factor and the time factor. The cost factor of that one is comparatively high, and the time duration is comparatively high, because if it's that is financial assistance for a long period of time, normally you have to repay that amount in that particular time period with a particular percentage of interest. So let us see the private infrastructure finance, that is the second one. So private infrastructure finance is for that is facilities and project involved in government borrowing money from private investors to pay for specific projects. So in cases of this one, they are borrowing money from the private investors to pay for a specific projects. So in this case, it's done to the project finance, where the project's specified company is set up to deliver a particular infrastructure project. So here the financial assistance is based on a particular infrastructural project, and that company then borrows the money, and a contract typically transfer the responsibility for designing, building, operating and maintaining the asset to these companies, in which the investors have managerial responsibilities. So these companies, they are designing that things, they are building that entire that is structure of that particular contract, they are operating these things, they are maintaining the asset, or they are managing the assets of these companies, in which the investors have managerial responsibilities. If they have some sort of managerial responsibilities, they are doing all these things in cases of a private infrastructural finance. In private infrastructural finance, the financial assistance are of two types, and the first one is private finance for a publicly owned companies, and private financial assistance for privately owned companies. Let us see what is private finance for a publicly owned infrastructural facilities. So here the advantages is cost and time overruns less likely. So here this is the most important advantages, the cost and time. This is a point we have already discussed in the previous one. The cost and time is over or less likely, that is the first advantage. And there will be situation of off balance sheet. So off balance sheet, as you know, the concept of off balance sheet, they are not showing the exact figure in the balance sheet. So you are making some changes of the figures in the balance sheet to produce in front of that is in front of a bank or a income tax authorities or somewhere. It is showing it is not showing the actual amount. You are making some changes in the balance sheet, and you are giving submitting the balance sheet for getting some advantages. So there will be a situation of off balance sheet in this type of financial situations. And the third one is a lower whole life cost. You can reducing the whole life cost factors. You can reducing the cost factor very easily if you are making a private finance for a publicly owned infrastructural financing situation. So you can minimize the later operational cost and reducing the total cost of infrastructure over the life cycle. You can reducing the operational cost. You can reducing the total cost of infrastructural facilities if you are taking such type of financial assistance. And some of the limitations is that are like this: higher financing cost factor, that will cost is very high, and a limited evidence of the benefit of risk transfer. And the evidence of risk factor, the limited evidence will be there for the limited evidence of the benefit will be there in cases of risk transfer facilities. And the third one is potentially inappropriate risk allocation. So there will be, of course, you have certain things like the process of risk management. So if you are providing some sort of financial assistance, and all these things will be there, so you have to transfer your risk. So you have a benefit of transferring your risk, and there will be the allocation of risk, that is you can give some that is you can make some changes, you can make some you can make some you can make some support or assistance for there is unexpected risk factors and situation. You can support such financial assistance from recovering of the existing risk situation. Then contractual inflexibility is the another limitation of in this case. There will be a flexibility over the change of contract. Of course, when you are taking a financial assistance on the part of a financing company, there will be flexibility will be there. So lack of flexibility, if you are feeling that if you are there will be some sort of a time period or some agreement that you have made yourself and you are funding that company. There is no flexibility. Means if you are taking the loan for 5 years, there will be you have to pay the amount to that entire time period. So if there is an option for repaying before that, there will be that is called some sort of flexibility there. You can pay the amount within 3 years. You can pay the amount within 2 years. So that is called a flexibility will be there. There will be an agreement is there. So if there is a flexibility, you can do things like that. So there is no contractual inflexibility. There is a contractual inflexibility is there. There is no things like that. You are there in a contract. You should strictly follow the things, and there is no changes are allowed over the contract that you are made during the time of taking such financial assistance. Then the limitations are the high financing cost, and the financing cost factor is high, and contractual inflexibility is another factor that we have already discussed, the contractual inflexibility. And the next one is private finance, privately owned infrastructural financial institutions. So in this case, the major advantages is like this: transferred responsibility. You have an option for transferring your responsibilities to a private sector institution. You can transfer your responsibility to a private owned institution. That is the first important advantages. And your financial cost situation, the lowering the financing cost other than form of private finance. So if you are taking so a lot of private financial assistance will be there, but by comparing to that one, you can lower the cost as compared to other form of financial institutions. So that is the another important advantages of privately owned infrastructural facilities. So the credit facilities, loans guaranteed non-banking financial companies are borrowers in specific infrastructural services, especially as we know, these are the sectors where we can use the infrastructural facilities. As per the regulations of Reserve Bank of India, any non-banking financial company can be registered as an infrastructural finance company. Subject to these could be non-deposit accepting loan company, deposit accepting loan company, and must comply with the following conditions. So that is the most important thing. As per the regulations of Reserve Bank of India, any non-banking financial company, that is any non-banking financial company, can be registered as an infrastructural finance company. So it is a non-deposit accepting loan company. It is non-depositing accepting loan company. So in addition to that, there will be some sort of terms and conditions with a minimum 75% of total asset of the company should be displayed in the infrastructure loans. That is the first one. And the second one, the company must have a minimum net worth of rupees 300 crores. That is the second one. And the capital risk weighted asset ratio, or CRAR, of the company would be at 15%, with tier 1 capital at 10%. So that is the third condition. And the next condition, the company should have a minimum credit rating of A. That is another one, or equivalent of CRISIL. So that is the important one, or equivalent to any other accrediting rating agencies. So the credit rating of the company is A. That is the fourth point. So this is one of the company that is in Indian market, Indian infrastructural financial company, that is established by Government of India in 2006, provided infrastructural facilities and assistance. Project there will be some special type of infrastructural facilities and assistance for the development of different infrastructural projects. And IFCL India Infrastructural Finance Company Limited, it will be providing financial assistance and will be it is approved by government and Reserve Bank of India, and the things will be, the act and all that things will be changed by time to time. So it is providing financial assistance, especially in case of transportation system, energy system. As we discussed from the first part of the video onwards, we are telling that the assistance, especially the major contribution from the part of transportation development, energy sector, water, sanitation, communication, social and commercial infrastructure. So all these things the company will be giving some sort of financial assistance. So Indian Infrastructure and Finance Company Limited, the major objectives are increasing private sector participation in infrastructure development through public private partnerships. So that is the first objective. And containing and reducing the fiscal deficit through private sector participation. So that is the next objective. And improve lending times for infrastructure project. That is the third objectives. So the three objectives of these companies. And some of the infrastructure financing companies in India is the Sherry Infrastructure Finance Company Limited, IL&FS Maritime Infrastructure Company Limited, L&T Infrastructure and Finance Company Limited, Infrastructure Leasing and Financial Service Limited. These are some of the companies that is engaged in infrastructure facilities. In so many companies are there. I have mentioned only 4 or 5 companies. So infrastructure financing is one of the important area in financial service. So they are giving financial assistance for upliftment of different sectors or different areas. It is actually a social overhead capital situation. The investment in different areas like road, rail, airport, that is shipping port, hospitals, etc. And 3 important types of facilities are there, and 2 major types of financial assistance, that is in private and public financial assistance are there. In short, we can this is one of the important areas. Financial service is one of the important areas for the upliftment of the society, and most of the areas are they are not expecting any profit, and most of the investment patterns are mainly for the development of the society, especially the